Hello and welcome to the Investors Round Table, a three-way discussion where Graham Neary, Mark Simpson and myself, Roland Head, talk about shares, portfolios and the markets. Graham likes quality compounders, Mark looks for deep value, while I like reliable dividends. This time we're going to discuss the latest news from fashion firms Superdry and Dr Martens. And we'll also be taking a look at Money Supermarket, Ramsdens Holdings, and fund managers Ashmore, Polar Capital, and Premier Miton. Let's get started. So, Graham, Mark, great to be back with you again.
Hi, Roland. Good to see you.
Hi.
Hi, Graham.
Maybe today we could start with some news that's quite timely. It's come out just before we made this recording. First of all, there's Superdry, which announced a restructuring of its UK stores and a refinancing plan, and also the intent to delist its shares. And then there's also Dr Martens, which has issued yet another profit warning and doesn't seem to be going too well. So I guess these are both shares that have probably been of interest to quite a lot of listeners, certainly caught people's attention over the last year or so.
It all seems a bit complicated, doesn't it? It's a fundraising, but as far as I can tell, is it only Julian Dunkerton can take part in the
Well,
fundraising?
it's a bit strange. I think there's two options. There's an open offer that shareholders could take part in that's going to be at 1p a share, or there's a Dunkerton only placing at 5p a share. And I think I don't know if it's going to go down to a shareholder vote. I'm not sure.
They want them to approve both options, and then they're going to choose at a later date
Oh,
as
I
to
see.
which one they're going to use. So, yeah, I don't quite know. But the scary thing here is the delisting as well. Well, I guess the other scary thing is if they say shareholders don't vote for this, then they're going to put the company into admin. So it seems very little choice in reality here. You're trusting Dunkerton to run a company unlisted in your best interests. And yeah, if I do the maths, it's something like 93 million shares in issue at the moment, and it's between 200 and 700 million shares being issued. Even if you're willing to hold the delisted stock, you're severely diluted in the business. Yeah, I'm not sure
Yeah.
I'd consider it at this stage. I assume neither of you own Superdry at this point.
No, I don't.
No.
I suppose there's always been the potential for a takeover here, and you've got Superdry's market cap now in single figures. So I can imagine some shareholders might think that Julian Dunkerton is going to take it private and it will come round, and that these shares could be worth a lot more in the future, even though they're delisted. But I don't know about either of you. I've never held shares in a privately listed company, and I wouldn't be too keen on doing it here. Although the company says there may be some kind of matched bargain facility, I think it will be difficult to get in and out. But Graham, do you have any thoughts on this kind of situation? Would you consider holding unlisted shares?
Yeah, I currently hold unlisted shares in a company that is being liquidated. And I bought the shares on the basis that it would be liquidated. That was my intention. A company called RDL Realization PLC, formerly Ranger Direct Lending. I have no problem in principle with owning unlisted shares, but it's something that does require trust, more trust than in a publicly listed company, because obviously the liquidity of the public listing means you can get out when you realize you've been fooled, whatever the case may be. It's definitely a big leap of faith to invest in this, because besides the problem of losing your liquidity, it's not really clear to me that this is enough money, £10 million.
No, it seems really not a very large amount at all, really, for a company that's doing kind of 500 million in annual sales and has a national store network and so on. You can imagine it could all disappear quite quickly, couldn't you? I suppose it's as much as they can conceivably raise, maybe.
I mean, there is a restructuring plan which will involve lenders taking they call it being compromised. So lenders are potentially going to take part or assist in a plan which will see a fewer number of stores, rent reductions in stores, and business rate compromises. The specialist lenders who've gotten involved, Hilco and Bantry Bay, are also involved in terms of extending the maturity of the loans. So if the lenders have bought into it and if landlords buy into it, you imagine that it would give the company breathing space for at least 6 months or a year. But long term, I still feel that £10 million is quite a small number for a company of this size. And it wouldn't surprise me at all if the 10 million ended up going to money heaven, as they say.
I think you've got a good point that I think I have ended up with some unlisted stocks in the past as they liquidate assets. But to buy into something with absolutely no plan for future returns is one of those that you really have to trust the management, because I know that some stocks that take over a company that don't get the required permissions, but they get enough percentage to delist the stock, they can be very aggressive in effectively getting minority holders out. They just don't pay dividends for decades. They have rights issues, which if you want, you have to keep putting more and more money in to keep your stake. Or they say, oh, we'll take it off your hands at the takeover price. And you think, yeah, I might as well just take the takeover price. Yeah. So, yeah, it's not for me, that sort of holding.
So yeah, I think Superdry, so it's one of those situations that could still get a lot worse. I think it would probably be a mistake to think this is as bad as it can get, probably. But another situation then maybe that we could look at that seems to be going from bad to worse as well, but has a longer history really than Superdry, is Dr Martens. So they've warned that wholesale orders from the US market are going to be looking like they're going to be lower than expected over the coming year. And basically, pre-tax profits could fall by as much as 2/3 relative to the year that's just ended on the 31st of March. And to me, it sounds like they may have excess inventory. They've got storage costs, debt, and now getting a new CEO as well. This is quite a famous older name, but another one of these dodgy IPOs that has worked out very badly from 2021. Do either of you, do you think that there's any kind of value emerging here? When you look at what profits have been in the past, is that an approach you take to look at past profits and think if they can get back to that level, this could be cheap? Or is there more of a kind of structural worry about this?
I'm never a strong sort of believer in that sort of argument. I've seen it a few times recently in companies where people have said, oh, but this used to trade at a certain valuation or a certain price. And I wonder whether you've got this anchoring bias where people get used to a certain price or a certain figure and that they assume that less than that is cheap and more than that is expensive. Typically for me, the sort of thing I'm looking for on the downside protection is tangible book value. So you've got something that has assets like inventories. Retailer has a lot of inventories. And I think that's one of the challenges here is that the Dr Martens ended up with 6 months worth of inventories. But when I look on Wikipedia, I look at the tangible book value, it's kind of 9 times. Okay, that hasn't taken into the fact that the price has fallen by 1/3. But so let's say 6 times book value. Tangible value, sorry, that's still not providing a lot of downside protection or a kind of figure to anchor on. Yeah, so for me, that's it's so far it seems a risky bet to play. I'd want to see that balance sheet. What about you, Graham?
Yeah, so this is a 2021 IPO. And I think one of the reasons there's been so few IPOs in recent years is because people are still nursing the losses from 2021. And Doc Martens is an example of that. In theory, I'd be open to investing in this, but you have to bear in mind that it is just a single brand business. So in fashion, you'd expect that to be reflected in valuation, that it's just a single brand. Therefore, there's risk there if there's any fashion movement away from the brand. So I own Burberry, which is obviously luxury. Doc Martens isn't luxury, but it is fashion brand where styles can come and go. And it seems that Doc Martens have failed to anticipate the demand that they would enjoy over the coming months. They also mention inflation in the cost base and that they basically anticipated having a much larger business or a larger business and they built their cost base around that. So it's a combination of weak demand and management failing to anticipate weak demand. Not that would be easy, but it's not a stock that would particularly interest me. Maybe we can only really value it on price to sales now in some way because profits in the short term could be anything. They say it could be 1/3 of last year, but then it could also be a lot higher than that. So profits is going to be extremely volatile. There's going to be a huge amount of operational leverage in a bad sense. Difficult to value now at this point, I would say. And you could look at the price to sales and say that maybe it's cheap because market cap of, is it about £600 million? And they did £1 billion of sales last year. You could see some argument for a recovery there, but it does seem speculative at this point on when a recovery might happen and how likely it is.
Yeah, and I was looking at the last balance sheet, which was to the end of September. You can see they have built up a bit of debt over the last few years. So I think that here is 317 million of bank debt plus over 200 in lease liabilities. So this is quite a useful example. At the time, they said, "Oh, their net debt to EBITDA." I think they said that was 2 times, which might not seem all that alarming. One of the things with this ratio is, of course, when EBITDA falls, then that same level of net debt that looked comfortable starts to look quite uncomfortable. And that could be a concern here. I think it's a business that's generated double-digit margins and quite attractive returns, but now the profitability has collapsed and the costs are maybe out of control. I think it's one of those ones that would it pays to be a little bit patient, probably, before thinking about it and waiting for the next accounts. So Dr Martens and Superdry not seeming to be all that popular at the moment, with at least not around this table. Just briefly, we've had a couple more interesting takeovers or takeovers of nice smaller companies recently. There was Lock and Store, the self-storage people recently, and then Tclark as well, which has had an offer from this mechanical and electrical engineering specialist based in London, does a lot of work, I think, in big offices and data centers. And it's been around 135 years as an independent company, but it's been taken over by its largest shareholder, which doesn't look really all that generous to me.
28% premium. That's the low end of what you expect, isn't it? So,
yeah, 160p or so plus a dividend. So it was at that level in 2022 and once or twice before. So I don't know if you have any thoughts on this, Graham. Or Mark, sorry.
I was going to say, I've never been a fan of this company just because of the board remuneration. It just has, every time I've thought, oh, this looks kind of reasonable value. And then I've seen that just the size of the remuneration. I think it's a couple of million plus for the board off the top of my head. So you can see why it's a takeover offer. If you strip out those board costs, the profitability goes up by a third or a quarter or something like that. And that gives you your 20 something percent premium. And then it's not on a particularly demanding rating in the first place. I'm sure the management wouldn't have agreed this unless they're getting a very generous package out of it either. So it might be long-term savings, but for me, I think that's maybe a lesson for some other companies as well of, where the board earn a lot of money, it's an obvious cost saving for a rival or a private equity firm.
Yeah, in this case, the company is, I think it's a gas supplier and metering company. An energy supplier to commercial customers, I think, is the largest shareholder, and they're the people who are buying it. So it's in the trade, or at least a related area. So they should have a good understanding of the business and know the board well, I would guess. But I looked up the remuneration, actually. The 3 executive directors took home about 3.3 million last year from a business that generated a pre-tax profit of 7.6 million. So there is some room to pad out the margins.
Just unbelievable, isn't it?
Yeah.
And then they'll probably argue that they're a £600 million forecast revenue business, and therefore, but given the actual size of the company. And of course, I wouldn't have had an issue if they'd said, okay, we'll set ourselves some very challenging price targets for options and earn some of that through getting an option package that pays out. But at least half of it is the sort of base salary, isn't it? So yeah, it looked egregious to me, in my personal opinion.
Yeah, I've had historical issues with this company. One thing they did was they put out a trading update, which seemed very positive. And then you look up the broker note and there's downgrades, and there was no hint of a downgrade in the trading update. So that was one thing that kind of annoyed me. The other thing I noticed last year, I felt that they raised money and they diluted shareholders significantly to raise £10 million when they had a market cap of 60 million. And it was a lot of dilution, and they'd been paying dividends every year for the previous 5 years, which if they hadn't done that, then the fundraise would have been unnecessary. So that was my second issue with management, was they were acting like everything was going according to plan. Well, if that was true, then why are they diluting shareholders and paying after having paid dividends, which would have made the fundraise unnecessary? So that was another thing. Then there was dilution from a share option scheme, part of the remuneration package, which was another source of dilution. So I just felt that they weren't really, whether by accident or carelessness or for whatever reason, I just felt like they weren't really doing the best for shareholders that they could have done. And it's already a low margin business to begin with. Because of people like me, and the investment community isn't stupid, people put it on a low rating, which I thought was appropriate. And the companies decided, you can stick your low rating. We're leaving the market now. And even the tone of today's update is quite telling, where they almost seem angry with the stock market for not giving them a better rating. But I don't think it's deserved.
I was going to say two worrying things that I think are getting more common. One is people whinging about the stock market valuation when the business performance isn't that great. Or I think there was one in the paper of a loss-making biotech complaining about the UK market. And yeah, it's there's a reason that people like us don't want to invest in that sort of company. And then the other point I think is very good and I'm seeing that more and more, closet broker downgrades. The sad thing is it's been working. There's quite a few companies I've seen where the market, I think Tops Tiles was one that I picked out the other day, that they seem to have done the same and they don't have brokers that are particularly easy for us to access either. So yeah, you get this kind of downgrade, but it worked. The share price didn't fall by the 25% or whatever that they downgraded the broker number by. Could be lots of reasons for that. But my worry is that more and more companies are seeing this, sort of playing this game, seeing this tactic work for other companies, and they're going to play this game themselves. A worrying trend for me.
Yeah, it is, because it's fundamentally difficult for private investors to get broker coverage, isn't it? Even if you pay for a service like ResearchTree, it's only a subset, and some of it is just completely inaccessible. So it feels a bit like it's not entirely a level playing field with small caps especially. But
I think it's time we start telling management, oh, actually, I like the company, but I'm not investing because you've chosen a broker who doesn't make research available to individual investors. I think the more of that message that gets across, the more we may have more level playing field access.
yeah, I think especially with small caps, yeah. But maybe we should move on and take a look at one of our stocks today. I think, Mark, you were talking is another smaller firm, actually, Ramsden Holdings. You've been looking at that recently, have you?
Yeah, so it's come onto my radar because I think many, like you guys, and obviously many listeners, know about Downing Strategic Microcap Funds. They've been a kind of concentrated small cap microcap fund for a number of years, and with a really very generous management. Judith Mackenzie's always had a lot of time for individual investors, presented at Mellows, but I guess market conditions mean they haven't had some of the success, and I think they've potentially had a few investments that haven't really worked out how they'd like either, and they're now winding down, and there appears to be an overhang in a number of their stocks, of which Ramsden Holdings is one of them. I think we talked a bit about this, Graham. You are interested in H&T, which is another pawnbroker, and I think that obviously Ramsden's is a pawnbroker. But when you look at its breakdown of gross profit, the biggest gross profit came from its foreign currency department. And then second was jewelry retail. And then the pawnbroking side was 22% of gross profit in 2023. And then purchase of precious metals making up the other part. And very roughly, it's a quarter in each of these areas. And it means it's a sort of more balanced business than H&T, but also not as exposed to pawnbroking, if that's the kind of exposure you want. But looking at the kind of different areas it does, obviously pawnbroking in a situation where the economy isn't great can be a positive thing. It's also a time where strong gold prices should benefit the company, both from the people wanting to sell their precious metals and the fact that if they've got jewelry sitting in as pledged assets for the pawnbroking side, suddenly people have got more of an incentive to redeem those and pay for that. And if they don't, the company will easily cover its costs from that jewelry. In a strong gold price environment, and we've seen gold price rise a couple hundreds an ounce in the last couple of months, this is a business that should be doing really well. On top of that, the foreign currency, the outlook for people like Jet2 and things like that is that people are booking foreign holidays you feel like, oh, this is going the way of the dodo having foreign currency. Everybody's using a card. But you look at the actual reality here is that this seems to be a growing area. It's a profitable area. They've got a fee of about 1.6% on cash booked online. It's hard to beat even on kind of a zero commission card if you're then paying the withdrawal fees in country. Plus they've got a kind of prepaid card as well they sell. So it's actually a surprisingly competitive sort of foreign currency offering. And there'll always be some people who like having the physical card or the cash in their hand before going on holiday. So I think it's a decent business. It's a balanced business. It's one that should be doing really well from the current strong gold price, the strong kind of holiday market. Yet the P is about 8, it's about 5.5 yield. It's kind of 1.3 times book. And I think the reason it's so cheap is that we've had this overhang from Downing selling. We'll have to wait to the end of this month to find out whether they're out. So Downing provide an update at the end of the month as to their current holdings in that microcap trust. But given the price has risen maybe around 10% in the last week or so, it feels Downing might be out, that overhang might be cleared, and actually, yeah, this is a business that's going to perform pretty well in the current environment and is very modestly priced. So I think it's an interesting opportunity for that reason. And I know Graham's going to come back and say H&T is cheaper, and I think it is if you don't include the debt that H&T. But I personally think Ramsdens is a high quality business. Do you disagree with that, Graham, or are you with me on that one?
I think they're both quality. I do think H&T is higher quality, but I can see arguments for and against. So with H&T, you have essentially the absolute commander of pawnbroking. The pledge book is over 10 times bigger at H&T compared to Ramsdens. So it's on a totally different scale. H&T has been around for over 100 years. So it's got that brand and it's got just total control of pawnbroking. Ramsdens is a more optimistic investment. As I've said on a Stockopedia report, it's a diversified financial services provider. And as you correctly explained, each of its divisions is roughly the same size in terms of its contribution. Whereas H&T is very much anti-cyclical or counter-cyclical because difficult consumer conditions drive pawnbroking demand. At Ramsdens, it's more optimistic because, as you mentioned, it's tourism and holiday demand that drives the currency product. And retail is also very important, although retail is also important to H&T. But point being that I think Ramsdens, if they had a choice, would probably prefer a stronger economy. H&T would probably do better in a weaker economy. But Ramsdens is a great company, in my opinion. I have been a little skeptical, or well, I don't know if that's the right word, but I've been a little cautious about their store opening program because they're opening stores in the southeast, effectively around the corner from H&T stores that have probably been there for 50 years or 100, who knows how long, any length of time, 100 years. And so they're entering H&T's turf in the southeast, but it seems as if the market can sustain the presence of both in the same geographic area. And I would give Ramsdens credit for not being too aggressive with their store opening program. And they're very well versed in previous pawnbroking disasters from overexpansion. I think it's a great company and a high quality company.
Another point that probably worth making with Ramsdens is the management chief executive, Peter Kenyon. I think he has a pretty decent shareholding in the business. He's very much invested in it and a long-term part of it, I think, isn't he? His growth and the new stores do seem to be quite a measured pace to me. I think I live in the north and the nearest town to me is quite a small place, but there's actually 2 Ramsdens stores. One is if you like, the conventional format, foreign exchange and pawnbroking, but one is actually a dedicated jewelry store. They're not that old, I don't think, either of them, certainly the second one, but they both seem to do quite well, and they're obviously quite clearly differentiated as well. So I think there's a fair amount of thought gone into the store openings, or at least that's my kind of anecdotally the impression I get, but I can see the risk of going up against a long-established competitor.
Looking at the numbers here, I think he owns about sort of 3.6%. So it's sort of enough to align, but it's not a controlling stake
Yeah, I think
in that sense. And he does appear to be doing a bit of exercise some options and sell half to cover the costs. There's not a lot of fresh money going into the company from them, and apart from in 2020 was the last director buys that weren't. Oh no, sorry. I actually, that's one of the, looks like maybe a non-exec did buy in 2023, but yeah, for the main kind of exec team, I think they haven't bought recently. Yeah, I think you're right. It certainly aligns him to some extent. I guess they're probably in a closed period at the moment, which is why they're not potentially making an offer to Downing for some of their stock.
As we speak, the last update was the AGM update, I believe.
Yeah, March, I think, wasn't it?
March.
It seemed
just-
quite positive.
Just to be clear on the overhang, do we have a basis to think that Downing have sold further? Or because the last RNS I can see suggests they still had 10%?
This is another bugbear of mine, that there's various interpretations of the rules out there as to how people announce their various holdings. Yeah, one interpretation is as soon as they cross a threshold, they should issue an RNS. Another possible interpretation is that when a certain trade has finished executing, it's a bit of a debatable one. But the easy way to check this is that the trust itself issues a sort of update every month. Now, it's possible that they've sold to other Downing funds, and by doing so, the overall Downing holding remains at that level, and that this fund has sold down. But I don't quite get why they would sell in chunks rather than just do a block trade for the lot. So you can see that from their end of month updates, at the end of December, they had sort of 70, get my numbers right here, about 736,000 shares. By the end of January, that had gone down to 650,000, stayed the same by the February, and had then gone down to sort of 331,000 level at the end of March. So yeah, I don't know that overhang has cleared, but I have evidence from Downing, the Downing fund itself, that particular fund has been reducing its stake.
Yeah, so we won't really know for sure until we get the RNS then.
Or at the end of this month, you'll get another update from Downing. And if that's from the Downing Strategic Microcap Trust, and if they say 0, then they are a 0. They should RNS it unless it's gone to other Downing funds.
It's always hard to be sure what you're seeing sometimes, isn't it? Because you only see part of the picture, and there can be quite a lag until you see anything definitive. Whether we should move on and take a look at another financial services business of a different kind, I suppose. I was going to look at Money Supermarket this week, and it's going to be well known, I should think, to most people. It's one of the biggest UK price comparison websites. It covers areas like insurance, personal finance, so loans, credit cards, savings accounts, travel insurance, and utility switching. Although energy switching in the UK anyway, I think it is pretty much a non-existent business at the moment, and Money Supermarket have said themselves they don't expect any material progress on that this year. And another thing they do that they acquired a few years ago was the cashback business called Quidco, which added a chunk of revenue, although it's at lower margins. So Money Supermarket, for a long time, seemed like a great growth business, the whole price comparison sector. And then a while ago, it seemed to flatten out, and the business didn't look so attractive, and it derated a bit. But performance has really started to recover, I think, now since the pandemic and various other disruption. The latest trading update were released just today, I think, just before we recorded this, and they're seeing a lot of growth in car and home insurance, especially car insurance, high levels of switching, despite last year's regulatory change, which banned companies from what they call price walking, so charging renewal customers more than new customers for the same product, because I think there was some concern that might lead to less switching activity because supposedly everyone would be getting a fairer level of pricing. But car insurance prices have really gone up, and there seems to be a lot of switching going on, and Money Supermarket's insurance revenue rose by 21% in the first quarter. And overall, that business is about half of group revenue, so it's quite a material thing. To me, Money Supermarket, it's always been very profitable. highly cash generative. In recent times, it's been investing a bit more in IT, but fundamentally, it's not a high capex business. It doesn't have to spend a lot except software and marketing, really. It pays a nice dividend, and at the moment, you've got this business, it's on about 13 times earnings, a yield of about 5.5%. And this is for a company that got operating margins over 20% and it seems to be in a positive phase at the moment with rising earnings. So it looks like it's a bit unloved and quite cheap to me. I think the sector doesn't have the same growth potential it had in the past, but this has become quite a big business in terms of data and it started to offer some business to business services. And another thing I think about Money Supermarket is that it also owns the Money Saving Expert website. So that's the thing that Martin Lewis founded that they bought from him. And I think that maybe gives a little bit of differentiation because it's a sector where you see all these crazy adverts on TV because there's no real way, not very much way to differentiate some of these services. But I think Money Saving Expert gives them a bit more credibility and authority away from purely commercial activities, which is maybe not a bad thing. Graham, are you a fan of the price comparison businesses or the ones that are left on the UK market? I know at least one has gone private.
I used to own shares in Go Compare, and that was a great business. And it's now part of Future PLC. And Future PLC don't break out Go Compare. As far as I know, the way they report segments doesn't really give me much on what's happening at Go Compare, but they do say that Go Compare is still doing very well. Their most recent trading statement was just earlier this month where they said that as a group, their return to growth was actually being driven by strong performance in Go Compare. So that's interesting. That company is still doing very well as part of Future PLC. I think it's a great segment because it's typical sort of portal style website, bringing together consumers and a variety of providers of services. So it's a classic portal or marketplace type of a business, which should be highly profitable, and it is. And the market tends to get carved up by a few players, which have a very strong market power. Just for context, as far as I can tell, just from internet research, Compare the Market is by far the market leader. This is a 2022 survey, but Compare the Market had a 54% market share in motor insurance. Money Supermarket was second with 15%, and Go Compare was third with 14%, and Confused is also in there. But you can see that there's a bit of market share with Compare the Market being by far the market leader. I suppose long term, you'd wonder, can the market sort of sustain 4 big players, or maybe long term there'll only be 2 or 3? I would rate Money Supermarket's prospects quite highly, being that it has second place probably, or it's about the same as Go Compare probably. And the brand recognition is enormous. The ads obviously can't be ignored. Yeah, I'm a fan and think it's a great choice. Yeah.
How about you, Mark?
I'm not quite as positive as that. I guess it's what we define as cheap, and a 13 PE isn't quite cheap in my book, particularly given that the top line hasn't really grown that much outside like you say, that Quidco acquisition. I'm a little bit concerned that this is a pretty competitive business. It not necessarily on pricing. There's not really a price to the customer, but there is a competitiveness in terms of being the one that you click and you use to do the price comparison. I wonder whether this is a bit of a winner takes all in terms of the biggest company has the biggest market share, so they have the biggest marketing budget, so they're the ones that have the primetime TV slots, and whether they'll just effectively crowd this out. I was going to say that as well, which idiots actually use a price comparison website rather than Quidco or Top Cashback. But then when I was researching, I saw that they did actually buy Quidco. So they obviously saw where that was going. But I also do wonder whether that's a source of effectively loss of competitive edges. You've got to be pretty daft to be switching gas and electricity or internet provider or getting your car insurance and not getting a serious chunk of cash back yourself and trying to take the bulk of the referral for yourself rather than giving it to one of these sites. But then I've got to recognize that we're probably some of the more more savvy people on personal finance than your average Joe. Yeah, so I struggle to get excited by it for those reasons. I think, yeah, if the market was frothier, if you were seeing the kind of small caps on really high valuations, you were seeing the dividend yield on lots of companies in the kind of 3%, then just owning this for the 5 or 6% dividends that looks like it's going to grow by a few percent a year going forward for ad infinitum would be a nice own. But in the current market, I don't think we have those market conditions. Yeah, I guess I just see better opportunities elsewhere personally.
Yeah, it's probably fair to say that, like I said, it's not growing in the way it did in the past. And it is, although it's still very profitable, it's not as profitable as it once was. I think the operating margin has come down from about 30% in 2018 to low 20s today. So you could question the longer term outlook. But I guess another way of looking at it is perhaps that someone else, like someone bought Go Compare, there's possible that someone might like to buy this, and within a different structure, running it for cash could be quite a nice way to generate a return.
Yeah, I'm trying to think through the business here. Is the play buying another brand and developing that brand through your marketing strategy? Or is the play here just, if you're a competitor, is the play just to chuck the marketing budget and win market share by being the most annoying advert on TV? But I can see that as an argument. I can see that somebody would just say, actually, their position is better with 2 or 3 incumbents, and that the smaller players just get bought out. And being a listed company versus a unlisted one, it's probably there's a market price every day for everybody to look at, isn't there?
So yes, there could be a bit more consolidation, and that's actually, consolidation is actually quite a good link to the companies that Graham has chosen to talk about. There's asset manager. I think you're going to have a look at 3 of the small mid-size asset managers. They're deeply unloved at the moment, but possibly offering some opportunities.
I figured we weren't talking about enough companies, so I thought I'd pick 3 for us to go over.
I'm going to chuck a couple other into the mix in this one as well. So they're getting the money's worth today.
Yeah, I know we don't want this to go on too long as a podcast, but I just thought I'd give a quick roundup of some fund managers, and Mark, feel free to chuck in some more, of course. But I think there may be signs of light at the end of the tunnel, let's say. Maybe I'll start with the most positive one, POLR Capital. It actually saw inflows. On what basis can I say this? It's my impression that people consider this to be a high quality fund manager. It generally has higher valuation than the other fund managers, both in terms of PE multiple and in terms of the assets under management multiple that it tends to enjoy. And I put it on my best ideas list at Stockopedia for that reason, that I considered it potentially to be lower risk. Anyway, the company has informed the market that it actually saw net inflows in the most recent quarter, which is a big deal because POLR itself had seen outflows unusually, and most fund managers have had a long sequence of outflows. Yeah, so in Q4, they had net inflows of £56 million. That's basically zero. It's basically break even, given that total AUM is £21.9 billion. So a lot of the fund managers are saying the same thing. They're saying that interest rates have potentially peaked. Now, I think the outlook on interest rates is obviously very tough to call. Will we get interest rate cuts this year? Who knows? Most people seem to think we will get interest rate cuts at some point this year, but not just in the UK, but in the US. And then the question is, will this lead to equity inflows as people have more income to spare? And will this benefit the active fund managers? So I tend to look favorably upon the fund managers where I perceive that they have a niche or a few good niches. POLR has a good reputation in healthcare and in technology, but they also have other themes that they work on as well. They are a fairly conventional fund manager at the end of the day, but they have this reputation for excellence. I've been positive on this one for a while, and I remain positive on it. And I think it's amazing that they managed to get net inflows. Should I continue, or would anybody like to interrupt?
No, I'd say
Keep going.
we'll jump in at the end.
Okay, look, I'll keep it brief. We've got Ashmore, which is an emerging markets fund manager. And I really like their niche because I feel that it's difficult for many investors to invest in emerging markets, especially fixed income emerging markets, without specialist expertise. I'm sure you can find passive funds which will do it, but it's the sort of asset class where you would think an active fund manager would be able to use their expertise effectively. Now, unfortunately, Ashmore is still seeing outflows. They had a $2 billion outflow in the most recent quarter. Still a huge company. AUM there is now it's $52 billion. But they are moving into equities as well, which I think is quite interesting. And there's no harm in them having an equities unit. And they are getting inflows into their equities division. And again, this is a company where the commentary I feel is worth a look. They are wondering when is the Fed going to cut rates. Ashmore is a special case because what really boosts their performance is when the US dollar is weak. And so that foreign currencies and foreign fixed income assets become worth relatively more. So that's the main kind of macro variable there. But I'm a big fan of this one. Chief Executive Mark Coombs, he founded the business. He's the largest shareholder. He's a wealthy man because of his shareholding in Ashmore, which he runs. I think that one is always worth a look, and it pays an enormous yield, which we can only hope is sustainable. And then the last one I just wanted to mention before finishing up was Premier Miton, mid and small cap investor. Now, this one had a Q2 AUM update recently, only in the last few days, actually, where they did announce flows continuing. A smaller business, £10.7 billion of AUM, but potentially competition will get a little bit softer. We were talking about Downing earlier. After several years of difficulty in UK mid and small caps, maybe when this all shakes out, Premier Miton, which itself is a product of consolidation, will find that there are fewer managers competing with it in its asset class. I look favorably upon this one as well, as I do pretty much all of the fund managers. I think they're very interesting investments. And I'm hopeful that Premier Miton will also enjoy a rebound in due course. So that's my roundup on the fund managers.
Yeah, very good summary. Like I'm pretty positive on the sector like you. I think the idea that you've got this kind of cyclicality of fund flows in and out of equities, and I have no idea when it is. I guess it's bottomed for POLR, but the rest has not bottomed yet, but it's surely got to come at some point. And I'm going to add a few more in there. So you've got Jupiter, which is a fairly well-known one, generalist fund. You've got Lion Trust, which is more UK focused. You've got Impacts, which is obviously, they like to call it ESG, but yeah, impact investing. And then you've got the kind of tiny CLIG, as it's well known. Maynard Patton spoke about this one, City of London Investment Group, where it's a kind of closed-end discount fund manager in emerging markets. So you've got that kind of specialism, and then you've got when you get bigger, you've got M&G. And each of them have their speciality, and each of them are pretty much on the same sort of rating, paying a huge dividend. And I just think you can take your pick in this sector. If you want you can go for a big generalist like M&G, or if you think the UK is the most downtrodden market and is going to bounce back strongest, you can go for Lion Trust. Like you say, if you want the small caps, you can go for Premier. I think Lion Trust is the leader on the yield with about 11% at the moment, and they report trading tomorrow. So I guess we'll find out how well they're doing. I really struggle to choose between them, and I do wonder whether just almost like a sector play is the way to go. What do you think, Roland?
Yeah, I do like the idea that we've talked, or you and Graham have both really talked about differentiation and having their special niches. And I think that's something I would look at with these. And for me, Impacts is one of the most differentiated ones probably on the UK market, and maybe Ashmore too, for reasons as Graham explained. So I like those and some of the others too. But I suppose one trend I've noticed that I don't know if it's really if it's significant or not. It's tempting to see turning points sometimes where turning points haven't really arrived, isn't it? But although most of the recent updates have seen net outflows, they've also tended to report positive market movements, quite a few of them. And so two implications perhaps that, first of all, maybe sentiment is improving and the stronger market performance will draw some inflows in over the coming months or whatever. But I suppose the other thing you could say is that people who sold out of these funds when they were on their way down are now in danger of missing the start of the recovery. They say, don't they? I think they say that the average private investor quite often underperforms even the wider market, because by timing the market and coming in and out of it, you inevitably miss some of the journey back up from the bottom.
Yeah, it's something like market timing costs the average investor about 1% a year, which doesn't sound loads, but it adds up to a fair chunk, maybe about 30% or so over the 25-year average investor kind of lifespan of building up a portfolio. That the worst is when it's more volatile. So one of my favorite statistics is the best performing fund manager from 1999 to 2009. So you've got a pretty turbulent period there. Was a guy called Ken Hebner, and he delivered for his shareholders something like a 17% return compound over that period, which considering period is a phenomenal return. The average investor in his fund generated something like a minus 21% return. And they did it by buying after he'd had good returns and selling after he'd had a few down years. And it's just, that's the reality of most people's experience of market timing, is that the more volatile the asset or the fund, the worse they are at market timing. And you've got ARK Invest is a more recent example of a volatile fund where the average investor has done far worse than the actual fund itself.
Yeah, that doesn't seem a very cheerful note to end on, does it?
On that bombshell.
But I think possibly on that bombshell that sometimes if you are committed to a strategy and you're happy with the fund manager, maybe it's a bit like owning shares. You do have to ride out the bad periods to get better results. But
one question on this, Graham, is there a sector ETF? Is there something? Yeah, because that's obviously one of the answers for this. Don't know.
For fund management shares?
Yeah, like I've not looked into it. I just thought off the top of my head whether that's an easy, low cost way of getting the exposure.
I don't think there's one in the UK, but I'm sure there'd be a financials ETF, of course. I'd be surprised if there was something as niche as a fund manager ETF. Another nice share we could look at in the future would be BlackRock. If we were ever going to look at a US share, a very high performing kind of vacuum of passive money, it'd be a good one to cover as a contrast with the active fund managers who have that headwind. But appreciate you bringing up, and I've studied them in the past. I think all of them, plenty to choose from. So each one has its own story, its own risks. But I do think POLR, Roland was saying about it's easy to see a turning point that may not have happened yet. POLR could very well see outflows next quarter. I'm not calling a bottom there for flows, but I do think it is noteworthy that they saw inflows, even if they were very small. And the fact that AUM continues to rise, I think I want to say all of them, but let's say most of them. I suppose Ashmore would have fallen, but most of them saw their AUM rise despite outflows. And that's an important point to bear in mind, because even with fee erosion, total revenues can still rise even during outflows. I think the investment case is pretty easy to make, but it's obviously could be one that requires even more patience than it already has.
And potentially the stock markets are forward looking. So you want to generally be a little bit ahead of the actual financial performance of the company bottoming, don't you? So maybe when we see those if we start to see upgrades, like broker upgrades, that can be a sign that things might have bottomed.
But the yields are sustainable. You don't really need much from the share price as well. I think that's also worth pointing out. A lot of these are on basically double-digit yields. If they can keep paying that, you can almost say who cares about the share price? That's sustainable.
Yeah, if you can get 8 or 9%, some of these are offering that you mentioned, Graham, and you don't need much to beat the market on top of that, do you?
Yeah, particularly if you've got like cash holdings as well, that they can back it for a few years, which Lion Trust is the only one I hold at the moment. And that's my hope for that one, is it just keeps churning away those dividends. But the only kind of downside I have though with them is they are a bit of a black box, and people talk about different strategies and star fund managers and things like that. I'm not sure I'd be able to call the impact of those and the true underlying performance. I think I'm definitely thinking that a bit more of a shotgun approach and own a few of them is potentially a better option than just holding one. It's what I have at the moment.
Okay, I think we've just about covered everything. Thank you for listening to the Investors Roundtable podcast. Please subscribe and share if you enjoyed this episode. It really does help us out. If you have any questions for the roundtable, please leave them in the comment section below, and we will do our best to answer them in the next roundtable podcast. Once again, thank you for listening, and until next time, happy investing and goodbye.